Three growth stocks I'm looking to buy in 2024 with some significant upside. As always, we'll look at the historical performance, we'll take a look at some of their financial metrics, and we'll jump into their valuation to get to our intrinsic value, what our acceptable buy price is given that investor margin of safety, and look towards Wall Street to see their forecast for the next 12 months. Now, the first stock has been beaten down this week, in fact down 10% on Friday after reporting their earnings. Still, they are up 43% over the last year, and over the last 10 years we can see they are up 1,464%. In fact, their all-time high is at just under $2,000. They are still trading fairly high in the mid to upper end of the 52-week range. They do currently have a forward P of 50 and don't yet pay a dividend. So let's take a look at some of their financial metrics. As always, we do put a blind side to the earnings. It is susceptible to manipulation by management through accounting. So on the free cash flow side, 366 in 2014. Absolutely astronomical growth in 2023, $92.10. Although we do note the inconsistencies from 2014 to 2021, but overall it is moving in the right direction, although we want to point out that 2024 is expected to come down at just below $50. In terms of their sales growth, very strong, double-digit growth year on year. It does look like it increased very rapidly up to 2021 before coming down. Nonetheless, 37% in 2023 is a very, very strong metric. Their total sales has increased from just over $500 million in 2014 to 14.5 in 2023. Now, shares outstanding, as always, we love it when companies do share buybacks, returning excess cash to investor pockets. We want to see this number go down. Now, what Melli have done, as we can see here, they've done the opposite. They've issued shares. They have diluted your position over the last 10 years from 44 million to 51, but do note they had a very strong share price return over the last 10 years, and this isn't necessarily a very large issuance of shares, so nothing, in my personal opinion, that is a red flag indicator. Just to let you know, we have a free weekly newsletter with the latest article actually running through companies that aggressively do share buybacks, returning a lot of cash to investor pockets. Alongside this, we have other articles. If you want to grab a copy completely free, click on that pinned comment below. Moving on then, we have the ROIC. As always, whilst this is one of my 7 golden dividend metrics, I personally want to see 10% or more. Gives me faith management are able to effectively allocate their capital. From 2020, it has started to go uptrend, looking very positive in the more recent year of 25%. And in fact, from 2014 to 2017, we did see some nice double-digit numbers to this metric. Operating margin, now I want to see a minimum of 12% here. So we do note from 2018, it was pretty poor. In fact, a loss in both years to 2019. It has since then picked up, 2023 looking positive now at that 15% level, and hopefully that uptrend can continue. Free cash flow margin, whilst fairly inconsistent, the minimum we want to see is 5%, which we saw in 2021. Since then, both years bounced back very strongly, double-digit growth, 32% in 2023. For free cash flow margin, that is a very, very attractive figure. In terms of the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, this typically shows us the balance sheet strength. Now, what this shows is the number of years it would take the company to pay off all of their debt net of cash on hand. 2023, it wouldn't even take them one day to pay it all off. So they have a very strong balance sheet here. Very, very nice to note. And now when we take a look at their valuation, and as always, if you do enjoy the content values being provided, smash that like button and hit that subscribe and bell button so you are continually notified of these videos as they drop. We typically on the channel run through every single one of these models on a deep dive. For Melli's valuation today, we're going to jump straight to the intrinsic value, which as we can see is just the DCF model coming to $1,832. Now we do want to mention, to get to this value on the DCF model, we have used a forward-looking growth rate of 12%. So bear that in mind. That is the estimation we have used for the free cash flows moving forward, which is lower than the average growth rate and lower than analyst estimates. So a lot more conservative in my opinion. Based on that then, the margin of safety that we typically use on the channel is 10%, which we use if we believe it meets 3 criteria. Wide moat, strong financial metrics, good forward-looking data. For Melli right now, we see a 10% margin of safety, so the acceptable buy up to 1648. Right now, though, if you do want to look for a 15% margin of safety, you would be aiming for around 1557. So we see right now a 10 to 15% margin of safety for Melli. Personally, this is one that I do want to add to my portfolio. It does have some very strong metrics. It is growing at a very strong rate, having run through those metrics just now. But I would be liking to see between 15 to 20% margin of safety. So my buy price is around the 1,465 mark. In terms of Wall Street and what they expect over the next 12 months, well, they have a price target of $1,938 with upside of 19%, so they also believe it is a strong buy. Now, I know a lot of people already will be saying this isn't a dividend-paying company, but it is one that has paid a dividend in the past, which means in the near future it could be one that does reinstate it again. The next growth stock that is on my watch list to buy in 2024, it is Booking Holding BKNG. Now, this isn't one that paid a dividend. However, in their latest earnings that came out last week, they made an announcement that they are initiating a quarterly cash dividend of $8.75 per share. This works out to about a yield of 1%. Now, I know a lot of people will be saying that this is a very expensive price for a share, $3,506, but do bear in mind you can buy fractional shares, whether that's 0.1 of a share, 0.2, or even smaller at 0.01. It is currently trading in the mid to upper end of the 52-week range, and similar to Mercado Libre, it is also down 10% after reporting their earnings last week. Over the last year, however, it is up 44%, and over the last 10 years, up 159%. We can see it does have a forward PE sitting around that 20 mark. So let's get into their financial metrics. Free cash flow per share, very strong. In fact, nearly 4 times over the last 10 years, $53 to $194. It should come as no surprise. 2020, that was the year that we had the pandemic, and Booking Holdings is one very much oriented around travel. And since travel was essentially something that didn't happen in that year, no surprise why we also see that sales growth of negative 55%. Since then, though, 2021, 22 and 23, very strong double-digit growth to their top line. And when we look at this numerically, it's gone from 8.4 billion in 2014 to 21 billion in 2023. Another thing that we love about Booking Holdings, we can see their shares outstanding dropping phenomenally fast, down 53 million in 2014 to 36.5 in 2023, again returning a lot of excess cash to shareholder pockets. ROIC, very positive. Not only is it very strong double-digit growth, but it has been increasing over the last 10 years. And I'm personally satisfied with that drop, the justification due to the pandemic. And it did rebound very strongly with the more recent year, 47%, a very, very strong number for this metric. Operating margin, free cash flow margin, very strong as well. It has recovered from the 7% we saw in 2020, although we do know even in 2023 it is still lower than the pre-pandemic margins, but hopefully this is one when we're looking at the forward guidance we can see moving up to the 30s that we've seen recently with BKNG. Free cash flow margin pretty consistently around the mid-30s, very strong, nothing really to report there. The net debt to EBITDA as well, very low, 0.3 in 2023, in 2024, 0.26. So again, very strong balance sheet, looking very, very healthy. So taking a look at their valuation, and don't forget you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and on your watch list by clicking on the pinned comment below. So the intrinsic value, when we use a margin of safety of 10%, we can see it is a buy pretty much around that current trading price. When we get to 15%, it isn't quite there yet, around that 3364 level. And when we bring it down to around 20% at 3166, this is what I'm looking for this company to add, similar to Melli that we just analysed, for a 15 to 20% margin of safety. So looking to add around that $3,200 mark. In terms of Wall Street and what they're forecasting over the next 12 months, well, they have a price target just over $4,000 with upside of 14%. Again, similar to Mercado Libre, they are expecting this to be a very strong stock to buy now for very good growth in the future. We then move on to a semiconductor that we haven't analysed on the channel, which is ON Semiconductor Corporation. Now, they're down around 3% over the last year. Over the last 10 years, however, some very strong growth, up 716%. And we can see their all-time highs at just over $100 in summer last year. They're also trading towards the mid to lower end of the 52-week range with a forward PE of just under 18. Free cash flow per share, well, very strong growth, nearly 10 times over the last 10 years, 38 cents to 3.69. 2023 though, we do know it is expected to be lower when that report comes out, but it is expected in 2024 to rebound back strongly to over $3. Sales growth, again, a little bit inconsistent. We do see 2019 to 2020 with negative growth, but other than that, we're seeing some strong double-digit growth to their top line, 28% in 21, 24 in 2022, and we do see it slightly drop in 2023 down to single digits. Numerically speaking though, more than doubled their top line from under 3 billion to over 8 billion in 2022. Shares outstanding, a little bit of both, a little bit of issuing shares, a little bit of share buybacks, although the net position is that they have bought back around 2 million worth of shares over the last 10 years. Not much to really discuss on that point. ROIC, nice to note, it is increasing over the period. The last 2 years, very, very strong. 2023 expected strong as well at 24%. So again, what I would suggest is when you are looking at these videos, these episodes, do make a note of some of these metrics and some factors that you see in a lot of high quality companies, high ROIC, high margins, low net to EBITDAs, so that when you are reviewing companies on your own, you can see these metrics and see whether or not they meet those criteria. Operating margin then, again, it is increasing. We want to see around 16%. So over the last 2 years, it has looked very strong. 2023, again, pretty much expected to be the same as 2022. So some good numbers there. Free cash flow margin, again, it is increasing. The only thing we would say is that in 2023, it is expected to drop down to 7%, which isn't the worst. Our minimum we look for in the semiconductor industry is around that 5 to 7% level. So nice to see it is still at a fairly healthy level. In terms of the net debt to EBITDA, again, pretty common with the 3 companies we're looking to invest in 2024. Very low net debt to EBITDA levels, 0.18 in 2022, 0.36 in 2024 expected, with 2023 at 0.33. Still well below the 1.5 level we're looking for those semiconductor companies. So in terms of the valuation of ON, what we can see for the intrinsic value, it is the average of these 2 models on screen, coming to around $97. So with the current price around $76, we use that margin of safety of 10%, and it is an acceptable buy up to $87. When we move to 15%, up to $82, and we can see this company does have a nice margin of safety, not yet at 25%, but at least at that 20% mark. In terms of Wall Street and what they're expecting over the next 12 months, they have a price target of $90 with upside of 18%. So these are 3 companies that I am looking to add to the portfolio. Only one of them now recently, in fact, pays a dividend. That is Booking Holdings. But the other 2 do look like very strong contenders, and those are my price targets moving forwards. In terms of ON Semiconductors, it does look like a very strong company, and at a 25% level, it isn't too far off where I will start to dollar cost average into this company. As always, let me know your thoughts in the comments below, whether any of these are on your radar. Maybe you're going to add them to your watch list, or for whatever reason, they aren't ones that you want to take a look at. As always, have a great day. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.